Joining us, David Neuhauser is back on the show. Happy to say, from Livermore Partners, CIO. David, great to have you. So what do you think? Do we describe that correctly? Is this still mostly just like a tech valuation repricing, or is there something brewing, bigger picture underneath?
Yeah, so Oliver, I think there's a couple of things going on. I think, in one hand, like I said, it's still all about the macro and as far as where global growth is, where GDP is, and what the outlook is ahead. So I think on the surface, like you said, you see this stronger macro in terms of the U.S., at least on GDP, still got good wage growth, still got relatively low inflation, and that still tells you the equity trade is going to be alive and well. I think the difficulty for me is, you got to look forward. You don't look in the rearview mirror. And I think the forward path ahead is going to become a lot more bumpier ride than it has been. So you've seen the momentum trade by a lot of these technology stocks tied to AI, the Mag 7, NVIDIA, Tesla, and others. And I think now we're starting to see that reality is starting to play in terms of the actually earnings profile. And you're seeing this drawdown in some of those large names.
How much of this will be offset by a smoother rate cut path going forward? How much does that justify the rotation? David, did that really change the outcomes for regional banks, for real estate, for housing stocks? I mean, this stuff's going wild. And in the midst of the tech selling this morning, they're just piling into regional banks.
Yeah, so I think the one thing you look at here is, Federal Reserve monetary policy is key. The viewpoint, of course, is they're going to be on a cutting path. We've seen peak. So the first cut is, of course, expected to be in September ahead of the election. I think that's essentially baked in, though. So the rotation that we've witnessed here in the past several weeks, sort of out of tech, out of the large cap names into the Russell and the smaller cap names, that spread was so wide to begin with. That was a spread that was like 1,400 basis points, and now it's tightened to like 400 basis points. So I think that's about where it should be. I think, and the reason for that, of course, is they're looking at that monetary policy, thinking the Fed's next moves are going to start to cut. That's going to, of course, help the smaller names. And of course, the large names, as you described, have had such a run that, to see that rotation and profit taking was just a matter of time. So is this a key theme going forward? I think the data is going to be dependent on where things go, but I still think it's all about interest rates and it's all about the macro as well. And the outlook for some of these earnings, even these large companies, is reflective that even though the CapEx has been a big driver, we might be at peak cycle there in the short run. So we'll have to see. Okay.
So I guess to some extent, it's a bit of a fool's errand to try and perfectly separate out the two sides of the coin. Tech valuations being too high, needing to reprice, versus kind of the macro support to logically argue for a cyclical rotation. So in the second part then, David, to kind of home in on that and mine that deeper for a second, if the outcomes are that meaningfully shifted by like a 25 to 50 basis point move, do we get like a refresh in the cycle, or can we dodge an end of this cycle without a nasty pickup in unemployment, et cetera?
Yeah, so again, my personal view from I'll say the hedge fund, our Livermore, is that it's going to still be really difficult to see that sort of Goldilocks scenario where inflation just, goes down to the Fed's goal of 2% over the next, say, 12 to 18 months. The Fed has the ability to cut several times in 2025. I don't see that really playing out unless all of a sudden you see an economic cycle that has peaked and we start to see some of those numbers turn. I think the key there is going to be always unemployment. If you start to see that number tick up to 5% or above, if you start to see wage growth start to sputter, those are all going to be key dynamics. But today you see sort of those cracks forming, but there's nothing that tells you today that you're going to see sort of that cliff dive. So what the market's expecting, I would say, at least the probabilities are that it looks like we are going to have a soft landing. But personally, I'm just much more cynical, and I don't believe that's the case. So I think there's a lot more potential that we are near a peak in the short run. We've witnessed a peak, and that going forward, it's going to be a rockier road. But it's been a really tough thing to be calling going forward.
You also, though, point out there that the data do not necessarily indicate an immediate cliff, right? Maybe we start to get unemployment 5%, then we have that conversation. So even though you might be cynical or skeptical in the long term, it seems like short term you agree with kind of the view that we're not going over the rails at this moment.
Yeah, but at that point, you also have to remember there's the economy and there's monetary policy, what effects that has, and then there's just earnings and stocks, which a lot of investors care about. Where should they be? Why should they be invested? So again, I think if people have made a lot of money on technology, this is a great time for them to take profits and to reallocate capital. I think some funds have been doing that, of course, in the past month. I think that's going to continue, but I think ultimately they're going to need to see sort of the broad dynamics continue where earnings growth is stellar and it pays to own equities. And right now, even some of those the best names in the group, even on the consumer side, have started to pull back. So the next 12 months will dictate the path we're on.
Let's talk some investment themes while we got you, David, of course, in the portfolio. I know you like gold. Feel like that has been justified. We don't need to spend too much time there. We just put in fresh highs for gold before this pullback. Are you in Tesla right now? Walk me, because you've been in and out of Tesla over the years we've known each other. It had this big ramp up off the lows. Then we gave some back. What's your approach with that stock right now?
Yeah, so Tesla's really been just a great trading vehicle and for Livermore over the number of years. The issue with Tesla is how do you make money off of that? And I think that's always been difficult, whether you've been bullish or bearish. So I think timing is key, and that's the only way I look at it. So we have a small short position on it. We've had it recently. It's obviously starting to become profitable now with the stock being down 10% from their earnings call. I still think it's a company that's extremely overvalued, but again, it really trades on its own, and therefore it's always difficult because it's so emotionally driven, that company. So today, we still think there's a lot of downside, and if sort of our macro case on investing is that we're going to see further potential downside to the equity markets, then it's a good hedge. If you think this is just sort of a calmness and we'll continue to see an uptrend in equities, especially the high beta stocks like a Tesla or others, then obviously this is not something to be short.
Okay.
But overall, I think the dynamics suggest that it's going lower.
Okay. The last point here, looking at a few of your other moves recently, you cut positions in LVMH. Is that a macro reflection of softening coming? People can't spend the high-end stuff?
Yeah, for sure. So I like the luxury space. I've liked it for a long time. I think, as you know, that's kind of one of our themes of the hedge fund. Livermore, we like things that, we expected sort of the wealthy consumer, even in a downtrend, to continue their spending on the things that they like when luxury is a part of that. So I like LVMH and others. But at this point in time, again, I think the market's telling you that, again, that also is in a bit of a peak. So it was time to cut some positions there. And, could be essentially a range-bound trade for some time to come.
Okay. Well, it seems that their peers are already showing stress. Did you see that Kering report yesterday? The Gucci owner stock got slammed, and they've been getting crushed for like a year. So it seems like might be on the right track as LVMH, still has actually been all right. I mean, but Kering's just been getting wrecked. David, good stuff. Great to catch up. Thank you, sir.
All right. Thank you.
Yeah, good chat. All right, good ideas. David Neuhauser, CIO at Livermore Partners.